name is Tabunganjaya, and welcome to another episode of Analyst Insights, your plug for business, finance, and investment. Today, we're going to be looking at some topical issues that have transpired for the past weeks. And to help me do that, I'm joined by our usual competent analysts, Rufaro Zengeni and Rangama Kwati. Welcome, gentlemen.
Good afternoon, Taonga.
Thank you.
So let's get into it with our first port of call being the ZSE. In the past weeks, we have noticed that the ZSE has been running with the foreign sales being a significant phenomenon. Maybe, Rufaro, you can give us your view on that.
Okay, so I think the part of this market activity that's easier to explain is the foreign sales, because foreigners have taken a view that they want to exit ZIM. For the longest time, they were unable to ship their money out of the country, and they believe that the current exchange rate regime is not favorable, so you don't see a lot of foreign direct investment portfolio flows coming into the country because they're taking a haircut on entry. So this trend of foreign sales, it didn't start over this past week that we're reviewing. It's been happening for the last 12 months pretty much, and we expect to see a lot more of it. What's probably harder to explain is the rally in the market, given that the valuation is quite high already, and there hasn't been a lot of news in the last week in terms of positive catalysts like significant earnings growth or change in outlook that would justify the rally that we're seeing. So for me, it remains something of an enigma that there's this interest on the buy side and the market rallying. I don't know.
Right.
To add to that, Ranga.
Yeah, sure. As well as with Ranga coming in, maybe you can also add to the view on how hard it is with vis-a-vis with the annual reviews that have just come out that have signaled that for the past year we have experienced a GDP decline of about negative 4.1%. So maybe you can also comment on to that.
All right. Thanks so much. So. Yeah, we are noticing that there's a significant foreign selling in the market, but also there is a very significant buying on the market as well. So it sort of creates a balance, but obviously it could be a worrying balance in the sense that you want your market to be attracting foreign investors, because that's it's one of the ways in which foreign currency actually comes into the country. Usually foreign investors, before they commit to capital investments through FDIs, foreign direct investments, they tend to come into a territory through portfolio investments, usually on the stock market. So we, at this point in time, we want a scenario where foreigners are coming to invest, but right now foreigners are actually moving out of the ZSE. Look, the economic outlook hasn't been great for 2 years or so now, although this year there's been expectations that things could improve, obviously, because of a good agriculture season that we have just had, and also maybe expectations that there will be some output improvement on in the mining sector. But generally, these are not like big kind of issues that would justify the movements that we have seen, unless obviously there are some other things that are the markets that we are not privy to that are probably moving the markets as we speak.
Yeah, there's a point that you just touched on that could it be perhaps a turn in the economy, or it's just because there is too much liquidity? Maybe we just graze through that. Maybe we can just relook at that and maybe expand onto that. Maybe we starting with profile.
Yeah, I think so. When we talk about agriculture, we had a bump harvest last season. The season before that, we suffered a drought, and Warren Buffett likes to make the point that you don't buy a farm because you expect the next season to be good.
Yep.
You buy a farm because you have a view on the profitability of farming operations over a long period of time. And I think so. In a Zimbabwean context, what's happening at the moment is we had hyperinflation for a significant part of last year. We also had economic activity constrained because of COVID, and we're starting to look forward to a period in which the constraints wrought by COVID start to fall away, and perhaps we won't see another drought for many years to come if we're lucky. So what does that mean for the outlook, and what does that mean for valuations? So maybe some of the thinking behind the buying that we're seeing is that the West is behind us in terms of bad agricultural seasons. The West is behind us in terms of COVID, and that there is a lot of headroom. It's also quite hard to make sense of the numbers that have been reported, because firstly these are hard inflation adjusted numbers, so you're not necessarily comparing apples to apples when you look at the Zim dollar numbers reported, and there are base effects where some of the numbers that were reported last year were significantly lower because of COVID and because we were coming out of a drought. So it's not easy to have a clear view about what the outlook is. Although the market, from the movement that we've seen over the last week, the market is telling us that the view is bullish.
Okay, if I can just add also, maybe another thing that we need to look at when we are evaluating this activity on the market is maybe look at the profile of the investor. So earlier on, we were just discussing the capital flight that is linked to the foreign investor. So certainly the trading that's happening right now is not being driven by foreign activity, especially on the buying side. And when you actually analyze again, even in the last quarter or so, major movements were not being driven even by institutional investors. So it hasn't been pension funds or insurance companies or these long-term kind of investors that have been driving the market. It has been here and there a few entities, some individuals that ordinarily are not your typical investors on the market. Mostly they are hedging, mostly they've got access to Zim dollars. And you have to understand one thing, maybe just before we move to the next issue, that there has been a drive to localize infrastructure development. So we don't have foreign entities that are coming into the country for some of the foreign infrastructure development, and they're being done by local players, and even provision of certain services is being done by the local players who are being paid in Zimbabwean dollars. And just try to see if the numbers are huge, which other area, which other avenue can they park, can they allocate some of their proceeds from the work that they're doing. So I think we are seeing part of that money coming onto to the market. But you need a scenario where your institutions are playing at the highest level and also your foreign investors are playing at the highest level. Right now, that doesn't seem to be the case.
Quite some interesting views there. Please catch us right after this message. welcome back. Moving on with our discussion, the minister recently announced incentives to attract listings on the VFX. Since there has only been one listing in the past 8 months, maybe Ranga, you can enlighten us on the incentives.
Thanks so much, Tawanga. So I think the major highlight there, especially for the capital markets, was the introduction of the retention the incremental exports retention scheme. So how it's going to work is for all the companies that are going to be listing on VFX, like exporting companies, that is, they're going to be allowed to retain 100% of the incremental exports. So this is coming from the current regime where exporters are retaining 60% of their export proceeds. So the whole idea is to incentivize those that are listing on the VFX, because now they'll be holding on to most, in fact, all of the foreign currency proceeds that they're going to be generating from incremental exports.
Thank you for that. But now the question might be, will this work, or how successful can it be, or can we expect it to be?
Okay, so before I go into whether I think these incentives are likely to work or not, I first want to unpack the last 8 months of the Victoria Falls Stock Exchange and why it hasn't been successful, because by any measure, a new stock exchange with only one listing, and even that one listing, if we were to look at the frequency and volume of trading in that counter, it's certainly not what a successful exchange would aspire to do. So, what went wrong? Why? I think we need to understand where the problems with the Victoria Falls Stock Exchange come from before we can assess whether these incentives actually address those problems and will turn around the fortunes of the exchange. So I think the Victoria Falls Stock Exchange was set up on the back of ban of trading on the Zimbabwe Stock Exchange, on the idea that the movements on the parallel market were driven by trading in the fungible stocks, Old Mutual and PPC, and the idea was to create an exchange that would trade in US dollars that would somehow solve this problem. And so it was a poor solution to a poorly defined problem. Old Mutual and PPC did not subsequently list on the Victoria Falls Stock Exchange, and it doesn't look like people are queuing up to list there. So I think there's some confidence issues underpinning the failure of the Victoria Falls Stock Exchange to be successful over the last 8 months that need to be addressed if we're going to see a turnaround in its fortunes. So do these incentives, do they move the needle? Are they going to change the game? Look, I think that obviously a current exporter, if they can retain 100% of incremental exports, it's an attractive incentive to them, and it's something that the board and management of any significant export operation is going to consider. But the question is, can they take Treasury at their word with these incentives and with this commitment to improving their conditions? Because in the past there's been a lot of chopping and changing, and the way the Victoria Falls exchange was set up did not engender confidence. And so I think that's what the debate will be in boardrooms, to say, look, getting 100% retention of incremental exports, that's exciting, but is there going to be policy consistency going forward? If they jump through the hoops required for listing, how confident can they be that they'll unlock the incentives and they'll get the returns that the incentives promise? So I think that'll be the question.
Yeah, but I think the other question is, when will the incentives end? because you will not thrive a market through just offering incentives anytime you want a certain outcome. So maybe we can perhaps touch on what is required from the government. Since that you have noted one aspect that the government is known to renege on some of its policies. So maybe we can touch on what other requirements are needed for the market to run on its own.
Thanks so much. Maybe just to take a step back a little bit, I would want to just highlight that, look, it's a positive development to the extent that they've realized that it's not possible for the VFX to be attracting listings with its current setup, with the current kind of regime. So you need to sweeten the offer, you need to sweeten bring some sweeteners so that more companies that are exporting could actually consider listing on the VFX. But obviously, there are a number of issues that may need to be addressed. Obviously, I thought maybe the starting point would be to, if possible, to conduct some sort of exit interview, as it were. Ask why all these foreigners have been moving out of the ZSE. It's not because they are running away from lack of incentives or otherwise. There must be a reason. So it is that reason that needs to be interrogated, and whatever policies and incentives that are going to be put in place should be the ones that address the concerns of the foreign investors. And also, it's important to also speak to potential listings, especially your big exporting companies in the mining sector, and say, okay, what would you want to see for you to be able to list on the VFX? I think the responses from the foreign investors that are currently moving out of the ZSE, and also the mining companies or the exporters that are not listed, would actually give us a better sense of what needs to be done. And I think obviously that has to be then buttressed by consistency in policies. Maybe as opposed to incentives, we just need to have predictable economic policies that are not dependent on whatever changes that might come from every now and then. So the incentives are good, but they're probably not the best thing that we could think of. And I think it's still important to get the input of the foreigners that have been coming into Zim, why they are actually taking their money out, and also to get the exporting companies why the views as to why they are not listing on the Victoria Falls exchange. And even before you even think about the VFX, even the ZSE itself has been losing listings on a yearly basis. Yeah, even for the companies that are predominantly Zim forecast and generating local currency, there have not been many new listings. If anything, every year we are seeing one company that a company or two that are actually delisting, and maybe a common theme for most of them is they've actually, it's costly for them to maintain a listing, and they feel that they are not getting the value or the advantage of maintaining that listing, maybe through access to capital. So those are things that may need to be addressed, and they need to be addressed not only for the VFX, but for all the other exchanges that we have in the country.
We'll now take a break. Please stay tuned for the next segment where we'll touch on US inflation and as well as maize prices. Thank you. So we are weeks into the agricultural marketing season, and maybe we would like to touch on the gazetting of the producer prices for agricultural commodities. So maybe you can give us your views on that. We'll start with Fufana.
Okay, for my part, I'm a hardcore free market capitalist, so I believe that prices should be set by willing buyers and willing sellers. The moment you have an arbiter that sets prices outside of willing buyers and willing sellers, you tend to have unintended consequences, and you tend to create perverse incentives. So if we look at the current maize producer price at 38,000 Zim dollars, at the official rate that works out to about $450 US, whereas regionally, the market price of maize is less than $200 a ton. So, and it's particularly vexing because we've had a bumper harvest this year. The previous season was a drought, so there's much more supply. So you would think that if anybody is to set producer price, it would not be at a significant premium to regional prices. So when I apply my mind to it, it doesn't make sense. We also have a ban on the importation of maize, which I think, yes, we've had a bumper harvest, so certainly the importation of maize shouldn't be a priority, and we would not expect people to have currency allocated to them for the importation of maize. But I think certainly marketplaces that have free funds, for example, if it makes more sense for them to import it at a lower price, I don't see why they should be prohibited from doing so. So I look at the whole framework where you have producer prices imposed on the market as problematic, and this particular level of producer price for maize, that doesn't make sense.
Okay, thank you. Maybe let me just come in there. So I guess the idea of gazetting of these producer prices is to try and safeguard the producers, the farmers, against perceived exploitation that might happen if we go full throttle market pricing. But obviously, be that as it may, there's need to actually make sure that whatever prices that are gazetted, they are very close to reality, so that you don't create some perverse incentives where, okay, if the whole region is having a bumper harvest, then maybe the average price in the region is about 200, 250, depending. It doesn't really make sense to have Zim paying that much, because what will stop these other producers in neighboring countries from bringing their product here in Zim and selling at the high prices, or even some unscrupulous or people that are just taking advantage of the that price differences to import product and sell it to the GMB. So I think it's important that if we can, we just stick to the market prices. The market is actually a good mechanism for determining prices for anything. And we don't want to create incentives for rent-seeking behavior where some people try and take advantage of the producer prices. And it speaks to interference in the way the markets work. And I think any serious farmer who is there as a business must be able to know that the prices of their product actually determined. But I mean, because maize, for example, is a commodity, and there's global commodity pricing for that kind of a commodity. Why should they be different from what's being charged here? So I think for me, it's actually the level that I think is too much. And if we can then take it a step further and actually eradicate the incentives or the producer price completely, that would be helpful.
Thank you, gentlemen, for joining us, and to our viewers, thank you for staying tuned. Please like our Facebook page and subscribe to our YouTube channel using the details displayed on the screen.